Hello, everybody. Welcome to another Pepperstone Learn It Live webinar series. My name is Thomas Atkinson. As always, I'm joined by Tyrone Abella, and today we're going to be talking about MACD divergence using price action confirmation, one of Tyrone's favorite topics. In fact, I'd argue, Ty, that MACD could be one of your favorite indicators.
Oh, it definitely is, most definitely. Only because of the joy it brings me when you actually see it work out, which is a lot. So hopefully we'll get through some examples tonight of how you can apply it using price action and really joining the two together, because when you use the two together, that's when it really makes sense and actually works out. So hopefully we'll find some good examples and show you the tips and tricks on how to do that.
Thought it might be worthwhile to do a bit of a shout out to a few people that are already asking some questions, which we really do encourage. So hello, Peter. Hello, Joseph. Hopefully you're having a good night tonight, or morning if you're in Europe. Okay, so just before we get started, we would like to go through a risk warning. So the information provided in the videos or the webinar tonight has been produced by third parties and does not reflect the opinion of Pepperstone, and the information has been provided without any alteration or verification. And of course, all information tonight will be considered only general in nature, and you should seek your own financial advisor or other financial expert before making any decisions. So what are we going to be covering today? We're going to be looking at how to correctly identify MACD divergence, something a lot of people don't do correctly, I think, Ty. What type of divergence also is most reliable? Now, this is one that we're going to add a little bit of our real world trading experience to, because it's not always the one that the textbook says is the best in the real market, and we'll explain that. Facts you don't also know about MACD, and of course why price action confirmation is key to MACD's success. And then at the end we'll do a few Q&A. So if you have questions and we don't answer them during the webinar, please feel free to ask them, and we'll see if we can get to a few of those near the end. So before we jump into MACD, we want to talk about the top-down approach. Now, we rattle on about this almost every week, I feel, Ty, don't we? The top-down approach.
We do, but only because it's one of the most important things that you can do when you are looking for, trading analysis in particular. On the smaller time frames, you ignore the big ones at your own peril. So it's really, really important to highlight that, and we drum it into everybody every single week, because it's what we do every single week. So we really just want people to we want people to do what we do, because we know how to do it and how to make it successful. And the only way you're going to be successful and trade like professionals is if you actually use the top-down approach. And I really mean that when you do that, it's going to make a big difference to how you place your trades and what your expectations of the trades that you're placing are.
One thing that we're really big on is, even if you're trading a 5 minute, 1 minute, which lots of guys out there are, we know, we were there, we used to love those timeframes so much. Just have a look at that 1 hour, have a look at that 4 hour and daily, and start to get an idea of what the trend's doing, because the big money is on the larger timeframes. That's where the banks are making large, massive, longer term decisions. And whether we like to admit it or not, it does move what happens on the smaller time frames. And the algorithms and all of those type of robot traders are also very big on the small time frames, making it go up and down very quickly. So having an idea of where the trends are helps us gain a small edge in the market. So always make sure you look at that. Paul seems to be having problems with the audio. Can some other guys just mention whether they're having any issues hearing me or Tyrone, or if we're clear? All good? Perfect. Okay. Thanks, guys. All right, so let's move on to MACD, moving average, convergence, divergence, and what it really is. And again, indicators are often misunderstood. I think that a lot of people, even myself included, I'll speak from a personal experience. When I first started looking at these charts back in the mid 2000s, early 2000s, I just took stochastic and went, okay, what are the numbers? And I'm just going to use that. I didn't actually understand what it meant. And it's important to understand what every indicator means and how that logically lines back into the market, and at the end of the day, the psychology of the market. So Ty, do you want to step us through MACD and really what it is and how it's made up?
Yeah, definitely. I think one of the keys to indicators in particular is actually, before you actually start using it, is to actually really understand exactly what it is that the indicator does. Because when you know exactly what it is trying to tell you, it makes a very, very big difference on how you use it. A lot of people actually fall into the trap of just doing a YouTube video on how to trade using an indicator, but actually fail to understand what that indicator actually does, which really enlightens your view on what the market's actually doing and how that indicator is actually interacting with the price. So to give you a very quick description, what the MACD divergence convergence indicator does is it's a difference. The histogram that we can see on the screen here represents the difference between the two key moving averages that represent the MACD. So in this instance, we've got the 12 EMA and the 26 EMA, which is what you can see on the screen, the red and blue moving averages. So you'll notice that most MACD indicators have got a standard default setting of 12, 26, and 9. Okay, so the 12 and the 26 are basically the EMAs that are represented here that we can see on this screen. Okay, so when we look at these, we can highlight them on the chart as we've got here. We can point them out. But the good thing about the MACD is just by looking at the histogram, we know exactly where these moving averages are without actually having them on the screen. Because the difference in these two moving averages is represented by the height of the histogram. So to give you a bit of an example of what I'm talking about, where we've got the MACD histogram line here with the black arrow, that histogram is representing the distance between the blue moving average and the red moving average. The red one being the faster one. So whenever the red moving average is above the blue moving average, so in this case, for probably the majority of the 2/3 of the chart, the histogram is above the zero line. Now, in the other part where the red moving average crosses below the blue moving average, that's when you'll notice that the histogram itself actually goes below zero and starts printing below the zero line. And again, as those two moving averages separate, the histogram gets bigger. And then when the two moving averages start to get closer together, the histogram starts to get smaller. So what do moving averages tell us about the market? When we see the red moving average, which is the faster one, accelerating away from the slower one, and by that I mean starting to deviate away from it, so it's getting further and further away from it, that's showing us that the momentum in the market is actually picking up speed. Okay, so as the moving averages are starting to get further and further apart, the market is picking up momentum and actually increasing its speed. And then at the peak of the histogram, when the moving average starts to slow down and they start to actually become closer again, and the red one starts to come and approach the blue one, the histogram gets smaller and smaller all the way until it actually crosses. So if we were to actually draw vertical lines on every cross of this moving average that we see on the screen, you'll notice that that is when the histogram switches from below zero to above zero, or above zero to below zero. Okay, now, why is this important? It's important because just at the glance of the MACD indicator, we know exactly where these moving averages are on the chart without them being on the chart. So we can read the market's momentum very, very quickly, just at a glance, really, whether it's actually increasing in speed, so you can actually see the histogram growing, or whether it's actually decreasing in speed as it starts to get lower and approaching the zero from above or below it. So that gives us, that information is instant. We know the momentum of the market almost instantly. But what we're going to talk about as well today, not only are we going to talk about how the MACD basically interacts with price, we're going to talk about some of the divergences as well that we're going to be looking for to isolate when the MACD is the most useful and when the chart is actually moving in the right direction for us to actually place a trade. The last
Yeah, I've
number
got a
that you'll
couple
see
of
on the
live
MACD
examples actually.
calculation, sorry?
I said we've got some live examples that we'll actually look at the market later. Have a look.
Oh,
So
yeah,
that'd be good.
perfect. Yeah, so what we'll also just quickly touch on, we don't usually trade the 9 moving average a lot, but I'll certainly explain it just for people out there who would like to potentially trade it. The 9 moving average is an average of those two moving averages. So there's a signal line, which is the red line that runs through the histogram, is basically a smooth moving average of those two moving averages. Probably sounds a little bit confusing, but if you can imagine, it's the MACD's got its own basically it's basically its own moving average, really. That's what the red line is. Now, how people trade that, it's and look, it can work like as a strategy itself. I'd probably want to be incorporating a few more keys to it, but if you wanted to trade that as a strategy, a lot of people go short when the red line exits the histogram when it's above the zero, and they go long when it exits the histogram from below the zero. So we'll highlight a couple of those positions there. So you can see here we've got our little yellow thing. When the moving averages flicks from zero, that's what they're all across us. But when the red line actually exits the histogram from right there, that's when people take a short position. And when it exits the histogram from below, that's when they can take a long position. So you can see that trading that certainly has given you some reasonable entry points on this chart. But what we've found is that this is not a bad strategy if you're incorporating it with other more important information. What we feel is more important, like price action, potentially looking at support resistance zones when this is happening. But if you're looking for something fairly basic to trade, especially if you're just starting out, it's certainly powerful enough to do.
Yeah, I think it's actually better than a lot of strategies people do use when they first start. It's amazing that something so basic actually works so well. So here we've got just a slide with a couple of examples of when it crosses below and above, of course, the zero, where it does that kind of movement, and of course what the market does after. So you can see it does predict a decent amount of the trend change, and then of course the trend reversal. Now this is most importantly a daily on the pound US dollar. So what you'll notice is that MACD works, I think, quite well on the daily. If you ever look at reports that are put out by UBS, by Goldman Sachs, by some of those other larger investment companies, they often mention the daily and weekly moving average being above or crossing from above the positive to the negative, or the negative to the positive. And that's really in probably most of their reports, I'd say, Ty, isn't it? I mean, it's one of the key indicators that I think a lot of the big guys do use.
It is, no, yeah, most definitely, and it is one of the clearest that gives very, very clear and crisp signals that can't really be misunderstood if you know what the MACD indicator actually does. So it's quite an important one to master. And like Thomas said earlier, if I had a choice and it was the last indicator, or if I was only allowed to use one indicator, that would be the one, because the MACD gives me more information than most, and understanding exactly how it works can be very, very powerful.
So here we've got just the US 500, and I've just got here a daily MACD on. The only reason I really put that on there is that we do know that indexes are inherently bullish. So they're inherently going to go long, generally speaking, for longer periods of time than they go short. Obviously, the last big sell-off we had was the GFC. But what you'll see is that when that MACD did cross over here, it crossed, and you can see that happened just when it broke through that potential role reversal zone. So we saw the resistance happen, it did some consolidation, and it broke above. So that happens just at this point here, and the movement was quite significant. If we bring up something like the pound yen, I haven't really looked at this one with the same concept, but let's say we were looking at this descending triangle over here, which we've spoken about over the last couple of weeks of doing these webinars. When that happened, you'll notice that the MACD went from positive, which it was, and it started over here in January this year, and then it was mostly positive all the time on the daily until April. And then we saw the break happen in May, and when that break happened, at the same time, the MACD went even more negative. So it actually strengthened to that side, and that was a very strong downtrend. So you can see that by bringing the price action together, we've got this descending triangle followed by a break, followed by, at the same time, we saw the MACD had already crossed to below the zero. And that's quite strong, isn't it, Ty? It's one of the things that we love to use as confirmation of our trade being successful or not.
Yeah, most definitely. And what you'll also notice, now don't, for people who are probably getting a little bit confused, these moving averages that we've got on the screen now are not the 12 and the 26. So yeah, the moving averages that we've got, although important, they are our important ones. They are actually the 20 and the 50 and the 200. Okay, so when we've got moving average, like I said, when we've got MACD on the chart, we don't need the 12 and the 26 on the chart. That's the whole point. But they certainly do give you a little bit of a speed up on the cross. They definitely give you a clue as to when the market is changing before it does change. So yeah, very important to keep that in mind. So, but like Thomas said, yeah, we can see here that the clues that we got came fairly early on the break of that descending triangle, and it proved to be a very good trade actually. You can see
Yeah,
how early it did actually cross.
it crossed a little bit, and sometimes it can be a precursor. If we go to something like the euro pound, we'll talk about this a little bit later. I've got this up as an example for a few other things. The actual cross to the positive happened here. However, that may not have been the time that we want to get in the market. There's another time in the future that we want to get in on the market, and we'll talk about that right after we go back to the slides. But what it does show is it shows this, the market is already thinking about getting potentially more positive. Often you'll see the crosses happen also at points of role reversal. So you'll want to use the price action to give yourself just that little bit more of an edge on the market, a little bit more high statistics, where the price action will show you that break along with the MACD. It's like bringing 2 and 2 together. So let's get back into the slides and go through the different types of moving average, convergence, divergence. Let's quickly switch this. Okay, so we've got basically 3 main types of MACD divergence. We've got Class A, Class B, and Class C. And I think, Tyrone, you and I have done a lot of real world trading with these different types of divergences. We've kind of got our favorite now, I think. We've pretty much unified our favorite, and that we'll talk about soon, but we do need to talk about all of them because it's important you know each type and what makes some stronger than others. So let's start with Class A divergence.
Okay, I'll take Class A. So with Class A divergence, it is considered, well, two of these divergences are considered equally as strong, but the A and B are definitely the strongest. A divergence is basically when you can see here we've got on the first one, we've got price making a lower low, and we've got the indicator making a higher low. Okay, so what we mean by that is that you'll notice in price, price makes a new low, it basically breaks down and goes lower than the previous trough, but the indicator doesn't do that. So the histogram makes a low at the first point, but then makes a higher low on the second point. And it'll be easy to show you in a live example, but that's what we call Class A divergence, where the price action and the indicator are actually showing completely different information. Now, remember that in a perfectly normal market where everything is running very, very smoothly, you would expect that if price makes a higher high or a lower low, the MACD indicator would also make a higher high or a higher low. So they were working in sync. What we're looking for here when we're looking for divergence is those situations where the indicator and price are actually showing two different things. And what that's telling us is that if price, now think about it logically for a minute, if price is making a lower low, but the indicator is failing to make that lower low, what's that telling us about the two moving averages that are forming the MACD? Okay, it's telling us that the slower moving average is closer to the faster moving average at the second peak or at the second trough than it was at the first one. So although price has actually gone lower in this instance, we're looking at the bullish divergence, price has gone lower, but the MACD histogram has actually made a higher low, which means that the fast moving average, which is below the slow one, is actually slowing up and momentum is shifting and it's starting to move closer to the slower moving average. So although price has given us a key that it's gone lower, it's done it with less momentum. Okay, and that's where the divergence lies. And same with the bearish divergence. So price makes a higher high and the MACD indicator's histogram makes a lower high. So again, it's telling us that price has gone up and pushed to a brand new high. The MACD isn't validating that move, so there's something not quite right. Two are not in sync. The fast moving average has considerably slowed down to the point where it's a lot closer to the slower moving average than it was before the previous peak that was lower. Now, in a real market, it's probably easy to show here. You can see here that price has made a lower low where the bottom of the blue dotted line is, but the histogram has made a higher low. Okay, so this is the bullish divergence that we were talking about. So this is Class A at its best.
Pretty much.
Okay.
It's quite a strong indicator from that one. So I think I might have a example of potential Class A appearing right now. So let's just quickly get in on that. I'll enlarge it. And we'll have a look at probably one of the US dollar pairs, because a lot of reversal going on in the US dollar pairs at the moment. So let's see if the market was preempting some of those things. So here over here on the pound, we've got the pound US dollar, and we can see that while the market has made a lower low, however, it's done so with less strength when it made that lower low. And now straight after that has happened, it's gone quite bullish. So what do you think about this one, Ty? I mean, in terms of what the market's telling us right now.
It's a really good example. Perhaps we'll actually draw the lines for everybody so they completely understand exactly what we're talking about. So we'll draw the two lines that we're talking about. So you can see that price has made that lower low, as we've discussed, and the MACD has made a higher low. Okay, so that's class A bullish divergence right there. Very easy to spot. But again, what we're saying here is that the price, even though it's made a lower low, it's done it with less momentum than the previous trough, and that's a significant part. That's what we're looking to trade, because we know, pretty much for a fact that the moving average has slowed down. The fast moving average has slowed down enough to get closer to the slower moving average, bringing them together, and that is generally a bullish sign, even though price has made a lower low. So it's almost like price, it's not that it's artificially got there, but it's got there with certainly a lot less power. And that's what we're looking for in the market. When we're looking for a potential trend reversal or a move in the opposite direction, we're looking for those clues that price, and what we're seeing with price, isn't all that it seems. Everybody thinks that because price has made a lower low, it's going to continue to do that. But there are weaknesses in the market, or little clues that we can get that are giving us the indication that momentum is starting to shift. And what you want to do, obviously, is try to get in on that shift as fast as possible, because that's going to give you the biggest move in the opposite direction when you do enter the trade.
So because tonight is about bringing in price action to our MACD divergence, well, let's have a look at this. I think it's a great example for it. I've drawn this horizontal line here at around the 127.50 area. And the reason I've done that is because this has acted as quite strong resistance in the past for the pound. We saw that big reversal coming off here. We've got that support that happened previously, and then we've had multiple tests to get above it. This is on the daily, by the way. Multiple tests to get above it, and it still hasn't been able to do so. So we've got that MACD divergence, class A, followed by some strength in the market, followed by a bit of a pullback into the moving averages here, which these ones I believe we set before. And then what if we saw the market do something like this? What if the market moved up and then came back and tested this? Because of the MACD divergence that we've seen and the break of the resistance, it would be quite a strong signal to us to say that the market has at least temporarily stopped being bearish and may potentially now be bullish. Would you agree with that one, Ty? I think it's pretty clear that that's a very strong signal.
Most definitely. Now, it's important to note that, if this does happen, it is a separate trade in itself. Okay, so initially, when you are trading MACD divergence, you're initially trading the change in momentum. But as Thomas has alluded to, you can see it's gone straight into a potential role reversal area. So I mean, you got resistance there. It was always going to find trouble there unless something really blasted it through. But now that it's come back, touch the two moving averages. Now, which I know we moved these two moving averages. What are those moving averages? Can we just highlight them?
Absolutely.
Are they actually the MACD moving averages? Or are they?
Yeah, so I set these to 26. I set them the wrong way around, and a 12. There you go.
Right. Okay. So Thomas has committed the cardinal sin.
That's right, guys. I did this because we were in the webinar.
Yeah, I always set the fastest moving average as red, because everyone knows that red cars go faster. So it's easy. It's always easy to, make sure that you've got your colors in line. So instantly, just by looking at it, that the color represents the moving average that you think you're looking at. Now, I always use red as the fastest moving average, so I associate that with the quick one. We know that's a 12. And again, this is pretty much what I'm saying. If you look at the price action at the first trough, you can see how far apart the two moving averages are. Okay, but then when you look at the second trough, you can see how close the red moving average is to the slower one, showing a significant shift in speed. And obviously that translates to momentum. So there was a very, very good signal there for us that price was going to turn around from that low, because a lot of the momentum has started to shift. Does that make sense to everybody?
It's often what you see at the end of a trend. And that's why, well, MACD is basically telling you that.
Absolutely. So that's Class A. So what we'll do now is move on to Class B divergence, which can be just as powerful. The letter B doesn't make it any less powerful because we can use that for a different reason. And it does actually offer a lot more trading opportunity sometimes in the Class A itself because you can get more confirmation from these areas. So I'll let Thomas take this one.
Yeah, so with Class B divergence, it's probably my favorite anyway. But basically, it's very similar, like all the divergences. However, in this case, price is making an equal low. I think it's also easier to spot. So it's one of those ones that if you're a beginner and you're only just starting to get into trading, Class B divergence might be the place that you want to start at. So what we're seeing here in terms of bullish divergence, we will see price making an equal low. So kind of like it's on support. And then at the same time that that's happening, we're going to see the indicator making a higher low. So the indicator is going to say the first time it touched was weaker than the second time it touched. And we'll look at a live example of what this might look like. The euro pound is a good example of this. For the type B bearish divergence, what we have is an equal high followed by the indicator telling us that all is not equal, and the second time it reached that equal high was actually weaker than the first time. So if we have a look at that in the market, we can see here that here is the first low, quite low on the histogram. The second low, much less low. So not nowhere near as low as it was, which shows weakness. It shows that the market is not as keen to be at that level and there's not as much power behind it.
Now, I can hear everybody screaming from the rooftops,
Yep.
if the price isn't making a lower low, how is it possible that it's better or potentially better than the Class A divergence? Now,
Sure.
there is a very, very good reason for that because when, like Thomas alluded to, if price is making an equal low or an equal high in the case of bearish divergence, what that generally means is that either a pattern is potentially forming, like a double top or a double bottom pattern, but also a lot of the times this is happening at a point of significant support or resistance. Now, the thing with Class A divergence is that can happen anywhere. It doesn't have to have a resistance point or a support point or indeed a chart pattern to actually appear. So in a sense, a lot of the time you're trading that in potentially isolation. Whereas when you're trading Class B divergence, generally you're going to find a lot more reasons to actually be in it. Now, for in the case of bullish divergence in Class B, you're more than likely going to have a support zone straight up. And we know support and resistance is one of the strongest indicators there is for, or charting techniques there is for predicting a potential price move. Or you're going to have, again, at the top, you're going to have resistance, or you're going to have a double top or a double bottom pattern. So straight up, you're probably going to have a chart pattern, a significant chart pattern, and support and resistance backing up your divergence. And that's why Class B can be so much more powerful, because Class A doesn't guarantee that you're going to have support or resistance, and indeed doesn't guarantee that you're going to have a chart pattern. In fact, quite often you won't have a chart pattern.
Yeah, you often won't. And it can be where you sometimes think it's going to happen and then it doesn't happen. That's one thing. Yeah. I mean, it's very easy to look in hindsight. I find that with Class B, it's much easier to actually see it, make clear decision about it, maybe back it up with something like a double top or a double bottom, like we see here with this double bottom where it's broken through and then of course showing quite a lot of strength after, and the divergence was very fierce here. But Tyrone said it as well as I could. It's all about trying to add as many reasons as possible, and therefore if you get the patterns on there and the price action agrees with your MACD divergence, it's a beautiful thing.
It is. And one of the things you'll find also is that Class B divergence generally does have a more explosive nature to it, primarily because it is generally coming off an area of support or resistance in the case of bearish divergence, and it generally has a chart pattern as well. Now, as we know with chart patterns, or for those of you who don't, they have a preconceived take profit level that most people will follow. So straight off the bat, we're going to be looking for at least a distance between the trough and the neckline. So this distance here that we've just measured for you, that gets projected past the neckline, and that is going to be your expected take profit. So straight up, we've got generally a pretty good understanding of where our take profit needs to be, or at least where the expectation of this particular trade is going to be. That is a big advantage that Class A divergence just doesn't really give you, because Class A divergence, you are a little bit lost in where it's potentially going and the explosive move that is going to come with it. We can not really know those things because there isn't enough backing it up.
You can see here as well, I just always want to point this out to everybody. If anyone's new here tonight, one thing that's great about patterns is they give you a projected take profit. What you can, yes, has this market gone further than projected take profit? Absolutely it has. But always take a lot of confidence in your trading methods to see these kind of candles. So what you'll often see is about 80% of the way towards the profit, there'll be some problems, because that's where a lot of people will take potentially some profit. Obviously we had resistance over here as well, but then when it hits the first and full take profit of the projection, you'll notice that the market does initially sell off, it breaks through, and then it uses that area as a role reversal area towards the buy side. And that is awesome. If you see that in any of your trades, whether you've taken only 100 pips and the trade goes 300 pips, you should be so happy, because you know that that type of thing is going to happen again, and the market has respected the level that you ended up taking profit at. I just cannot emphasize that much. There's enough, because it's all about confidence trading as well. It's psychology, it's confidence. We all know that you have enough, you have maybe 5, 6 successful trades, you feel great, and then you have two, literally you can just take 2 or 3 bad ones, and all of a sudden you're starting to question your trading systems. So by backing it up with real world data where you're seeing the market interact with your zones should make you a lot happier.
Now, the other thing I will add to this is also when you are, and for those of you who join us often, you know that we harp on and on and on about trade plans and how you should be planning for every trade and building a business case for every trade that you place in the way of a point system or anything like that. The one thing that Class B divergence does give you is many points. Generally, you're going to get at least 3 levels of point scoring for every Class B divergence trade there is. So yeah, for those of you who are not familiar with that, I'll pop a link in the chat window so you can have a look at a pressing system that we've designed that actually builds the trade for you, and you can actually build your score, and it gives you a score rating. It gives you a really good idea and understanding of how actually a scoring system works. Class B divergence rates very, very highly in our scoring system because it's always supported by at least 2 different elements in the market that are going to give it a little bit of a push in the direction that you think it's going to go.
Okay, so then it moves us on to Class C divergence. So pretty much with Class C divergence, it's probably the one you least want to use. And the main reason that is because what it in essence is saying is that if the market is making, let's say, a lower low in terms of bullish, so the price action is saying we are now lower than we were here, and the MACD is equal low, that we should be looking at a buy. Now, the problem with this is that the market is saying, okay, yeah, we've gotten here, but rather than like the other case where we saw weakness in the MACD, we're just seeing that it's equal. And that's just not as strong. I mean, the price action has gone further down. The price action is saying we're selling off, whereas the indicator is saying, well, it's actually equal. It's not any stronger than it was before. So it's basically like a weak version of Class A. And we do not like this version very much. In fact, I would probably say it's not really worth trading. Would you, Ty? I mean, I wouldn't use it personally.
Like we've said, it just doesn't give you enough evidence that the market is actually shifting. Okay, so and like I said, you got to think about it logically. Again, if the MACD indicator is only making an equal low, whilst price has made a lower low, all that's telling us is that the momentum is the same at both troughs in a bullish divergence and both peaks at a bearish divergence. It's not telling us that there's been a shift in momentum. It's just telling us that the momentum is the same, even though the price is a little bit lower or higher. That doesn't excite me, not when there's so much more evidence out there to actually build a trade. So that's why we ignore it. But look, it is an element of trading, so we have to discuss it. But just be mindful that it is certainly the very, very poorer brother of the other 2 divergences.
So I've just got a couple of examples here. We'll jump into these, just have a look. So we've got the odd US dollar, we can see here. Well, now we'll put it to the room. What kind of divergence are we seeing here, guys? I'll give everyone 30 seconds and I'll bring up another one.
It's very good, Peter.
Well done. Yeah, a few people are getting it right. That's good. So this is class A divergence. So definitely one of the good ones to go for. And one thing I just wanted to also mention here. So here we had, it's not so much anything that's happened with the divergence. It's just that I want to show you that we've got the US dollar CAD has started to sell off. It's come back up. It's done the role reversal at the point where it found support, becomes resistance. And then you can see that it's had a very aggressive sell off. And look at what the MACD has done. Very strongly gone down. So it just shows you, obviously it's based on this price action and this strong volume momentum, but you can see that it made a new low and it did so with definitely a lot more MACD.
And what this also highlights actually is probably a really good point in that, and I'm sure it's a question that we're going to get asked later on, which time frame is the best for isolating MACD divergence and how to trade it. MACD divergence is going to be available, and you're going to see it in every time frame on every basically instrument that you trade. Okay, its move is going to be relative to the time frame that you're on, but it's traded in the exact same manner no matter what time frame you see it. So you'll see it, and look, we're highlighting examples right in the live market now of it happening. It happens all of the time in all the different time frames. So if you do decide that you're going to be a MACD divergence trader and you're only going to trade MACD divergence, you're going to get many trading opportunities. There's no question about that in many different time frames. So you've just got to, like I said, the expectation of the trade is going to depend on obviously the time frame that you're on. You're not going to more than likely get a 600 pip move on a 15-minute divergence cycle. But on a daily or a weekly cycle, that is a very possible scenario. So that's probably the way to look at it. Just keep it, your take profit aims in line with the chart that you're on, and also aiming for those support and resistance zones in front of you, knowing that the market's going to have trouble breaking through those.
So we've actually got a few good questions here, Ty. I think I'll take Tim's one just because it's important that you understand what role reversal is. So when we defining role reversal, we talk about it quite a lot. I'd recommend either jumping into our webinar after this one, which we might send out soon, or checking out YouTube, Pepperstone's YouTube, and having a look at our previous webinars. We talk about role reversal a lot. Basically, it's where if you've got, like, let's say a level of support like we have here, so we've got this level of support where the market has found support again, and then it's broken through. The idea is that when it breaks through and it comes back up and tests that level that was once support will act as resistance, or if it was the opposite way, the resistance will act as support. So you can see here that's what the market did. This was a very clear level, everyone could see it. It then broke through, it came back up, and then it just so happens that when it was testing this level of role reversal, there was also a 200 moving average and a 50 on the daily. And that's one of our favorites. We love seeing this. So when that did happen, it's very good, type of trade.
Role reversal is just one of the, we've got so many traders who actually just trade role reversal on its own without any other indicator, and they do it very, very successfully. It's one of the most important elements in the market that you can use, and very, very clear. So look, if you don't know much about role reversal and you would like to, definitely check out the Pepperstone YouTube webinars, because I know we've done a couple just on role reversal or really highlighted it. And it's a very, very important concept and one you really want to get a grasp on. And it is also in our account builder that I've actually put in the chat window now. You can actually log on to that, and it's free to do, and that actually explains how role reversal works as well. But we've definitely done probably a couple with Pepperstone. So if you go to the YouTube channel, Pepperstone's webinars, role reversal will definitely give you a good insight as to why it's so important and how powerful it can really be when combined with other elements.
I got a question here from Zen about what point that we think that divergence is no longer valid and the entry is too late to trade. So what do you think about that one, Ty? It's a good question.
Look, the way I look at that one is I always use price action as the guide. Okay, so if for instance, when we're looking at this divergence here, the one we've got on the chart, we can still see that the power is still with the buyers. Okay, so we've still got solid momentum going up. What I like to do is go to a smaller time frame and have a look at what the price action is actually doing. What you'll find a lot of the time is that when you're seeing price action like this, if we go down to a smaller time frame like we have here, you can see that price is starting to make higher highs and higher lows. Okay, now while that's happening, and as long as that is happening after a reasonable amount of divergence, you can still safely say that it's not too late to get into that trade. What you don't want to be seeing then is basically the opposite happening, where price starts to make lower highs and lower lows on the smaller time frames. That's when it could be a little bit too late to enter. So the first things first, you have to isolate roughly where you're going to. Now, generally, the first place you're going to need to get out of a trade if you're trading divergence is the first place in the case of bullish divergence, sorry, the first place of serious resistance is probably going to be your first obstacle. So what you don't want to be doing is trading a divergence trade with something like the 200 moving average smack bang in your face, or a very serious level of resistance, because you're going to run into trouble almost instantly. Okay, so you really want to be able to keep the take profit at a reasonable level. So work out where your take profit's going to be, and just make sure that there is enough room there to give you a decent go at this trade before you have to either break even or potentially move your stop loss up.
I think we get this question every
here.
week. Yeah, that's okay.
It's still a good question. The moving averages. Okay, so the moving averages that we use, two that we're going to talk about. The ones that are related directly to the MACD, the 12 and the 26, they're both EMAs. Okay, so they're exponential moving averages. The ones that we have on the screen here, and the ones that we always use as a rule, the 20 is the red EMA, the 50 is the blue EMA, and the 200 is an SMA. So we always make the 200 an SMA because that's just more smoothed. But the two faster EMAs, the 20 and the 50, are always EMAs for us. We don't use SMAs on the smaller ones. Meredith, 200 SMA is generally the consensus that most people will use. So that's
in
the one that
indexes, a few people use 100 as well, and stocks.
Some people use 100 as well, but we like to stick to the 200 because sometimes you can get analysis paralysis, and like where does it end? I mean, I've seen so many moving averages on the chart without weight the bars. Realistically,
I've seen one that was like 5, 8, 12, 20, 26, 50. It was crazy. It was like a ribbon. They call it the ribbon.
Yeah, so you've got to pick your poison. You've got to pick the ones that make the most sense to you, and probably most importantly, pick the ones that everybody else is using as well. Because at the end of the day, you need as many people doing exactly what you're doing.
Okay, so there's also another type of divergence that we won't talk about in tonight's webinar, and that is hidden divergence. What is it? Whether it's good to do or not? Look, it's definitely something that some people really like looking at. You can obviously do some Google searching, but one thing we always say is pretty much the KISS principle: keep it simple, stupid. And sometimes too much information is not necessarily the best. And while we've used it, we've done some study with it, and we think it's okay. I think that it's better to understand the Class A and Class B and stick to that, and stick to the basics and price action, understanding the psychology to begin with. So that's probably what we would recommend there. And that really brings us on to what we harp on about all the time, which is create a business plan for your trading strategy. Of course, part of our course is the Pressix system, where we basically break down price action, risk management, ELD, chart patterns, indicators, and charting techniques. And we like to have one of each one of these letters basically before we place a trade. We like to have a strong reason for each one of those cases. And having a business plan was like, if you're going to be successful at business, most guys have some form of plan. There's very few that wing it and have success long term. And anyone that says they did, I either got really lucky or they usually are kind of lying to you, unfortunately.
Yeah,
so
the best traders have always got a plan. There's no question about that. And I know a lot of you in this room have actually been there and done our Pressing account building course, and it is free. For those of you who haven't, jump in on the link there and click on that, and you'll you can register for it for free and go through it, because it really highlights the importance of actually doing a plan for your trades, and really probably isolating the your ability to actually identify more than what just actually naturally meets the eye. And I think that's where a lot of traders get caught out. They just trade what they see and don't really put in the analysis on the other important aspects on what there is, to trade. So yeah, definitely take a look at that and go through it.
Okay, well, I think that probably brings us to the end of this webinar tonight. To everybody.